So one of the most important things to take into consideration when applying for a mortgage, and it's actually one of the most frequently asked questions, is how much is the bank going to approve me for? And the calculation the bank uses, it's known as the debt to income ratio. Basically, the bank is going to assess your monthly obligations versus your monthly income. So whatever they determine your monthly income is based on if you're a wage earner, it's going to be the gross income, or however they calculate your monthly income. What percent of your income, what percent of that income is your monthly obligations? So what are monthly obligations? So it's the things what are your monthly obligations? So the monthly obligations are the things that show up on your credit report. We'll break down your monthly obligations to 4 categories. So you have the mortgage that you're applying for, including taxes, insurance, HOA if there is, PMI, any cost associated with this purchase will be the first category. The second category is payments for your car, right? If it's a lease or a finance, the car payments. No insurance, just the car payments. The third category will be the minimum payments of your credit card. So, not to be confused with your credit card balance. Many people have balances of, $10,000, but the minimum payments is $100. So the minimum payments of your category, that's the third category. The fourth category is any loans that you have in your personal name. So, if you have student loans, if you own another property, child support, any loans that will show up in your credit report, that will be the fourth category. So now the bank will look at your monthly obligations and your monthly income. The banks ideally want your monthly debt to income ratio to be 45%. That means that your monthly obligations can be 45% of your income. Now, if you have good credit, and it's a nice file, the banks will let you go up to 50%, 49.9. So, generally most people, they're buying a house, primary residence, they have decent credit, and they can make a calculation based off of their monthly obligations being a little bit less than half of their monthly income. So say for example, you're buying a house and your monthly payments are going to be $2,500 a month. That's including taxes, insurance, all fees, right? $2,500 for the house. Then you have car payments, $350 on the car, and then you have your credit cards. Let's add all the minimum payments, $150. We have a round number, $3,000. So your monthly obligations, your monthly debt is $3,000. So your monthly income has to be at least double that. So, let's go with the ratio of 49.9% because, most solid borrowers are able to go up to those ratios. You would have to make a little bit over $6,000 to be able to qualify for a house, with a payment of $2,500 a month.